Hello, it's Jeff Christian of CPM Group. It's about 10 after 1 in the afternoon on Friday, the 20th of October here in New York. I want to talk about preparing for the next recession with gold and silver. I think it's a topic that is important to come. Now, in order to do that, I want to stress right out at the very beginning, A, we're not in a recession now, and B, the world is not collapsing. There will be recessions in the future, 100% certainty of that. One of them may be coming soon. CPM Group's own expectations have been and continue to be that we could easily see a recession in 2024 or 2025. That said, our economic projections are based on our analysis and our analysis of historical data and current market conditions. And the economic and financial systems have changed radically since 2008. Talked about that in past videos. So past relationships among economic data series and financial market conditions may not be as accurately predictive of future economic trends as they were before the Great Recession and the global financial crisis. And the third thing to understand is that recessions end. So before I get into how to deal with and how to weatherproof your wealth against future recessions, let's talk about the current state of the economy. As I said, we are not in a recession. This is world GDP, real inflation-adjusted GDP, with CPM Group's projections for 2023. And you can see that we have global growth slowing. We have growth in the industrialized world slowing, and growth in the developing economies slowing, and we have global growth slowing this year relative to last year in 2021. 2021 was that recovery year. It was a sharp bounce back from 2020. 2022 is a more appropriate measure, comparator. And you can see that, yes, we have it coming down. You also can see that 2022 and 2023 on a global basis, as well as in a world basis or advanced basis, in the advanced economies and the developing economies, basically in line with a lot of what we saw between 2013, 2012, and 2019. So we're sort of back to that pre-pandemic lockdown norm on a global basis. Now, I have a couple slides here. I apologize if they can't really be seen close up. On the left hand is the percentage change on a continuously compounded annual basis of U.S. GDP. And on the right hand is the actual level of inflation-adjusted gross domestic product in the United States. You can see that growth is on pace, and it's in line with what we've really seen over the last 20, 30, 40 years in the United States. For now, it's not necessarily, we're not in a recession. It's not necessarily predictive that we're about to go into a recession, because we go into recessions in one of two ways. Either we slowly slide into one, which is sort of what we're expecting next year, or the economy gets overheated, and then there's a crackdown, there's tightening, and then we go into a recession. So it's very difficult to predict the timing and the occasion of a recession. And don't look for a single cause. It will be a combination of causes: political, economic, international political, domestic political, financial market trends. But the reality is that economic growth is on pace, at least for now. We're not in a recession, and there's no signs here that we're about to collapse. Industrial production has slowed. It's just another measure. It's one of many measures that we look at in our projections for overall economic condition. It's slowed, but it's not contracting, at least not yet. It's, again, in line with what we've seen since, well, at least since the 1990s. And you can see on the right-hand chart, that's the actual level of an index of industrial production in the United States. And you can see that it's pretty high. It's actually pretty much close to record levels. We're clearly not in a situation where industrial production of manufactured goods has been shipped offshore, and that we're not producing anything anymore. From an industrial production perspective, we are. If I sometimes will compare this data with manufacturing jobs, which are off 50% from where they were in the late 1980s. But that's jobs, and that reflects not so much the U.S. not making anything anymore as it does the U.S. making things with computer-assisted and computer-controlled manufacturing processes at the expense of labor. Stock market's not collapsing. Yes, it was down. It's been down sharply last year for a while, then it sprung back into the end of last year, and it's down from where it was last year. But put it into perspective. This chart only goes back to 2014, and you'll see the stock market's not collapsing. There's no reason for all this hand-wringing that you see among gold and silver metal promoters. And similarly, the bond market's not collapsing. Yes, interest rates have risen, bond prices have fallen. They've risen all the way back to the lowest levels that they were prior to, say, 2000, 2001. And they are a fraction of where they were for most of the period before that. And a bond market collapse is what we saw, say, from 1976 to 1980, when interest rates went from 15% to, or 7% to about 15%. You're not there yet. I showed this chart last week. People aren't running from treasuries. They're not dumping the treasuries. Demand for the U.S. Treasury securities, bonds and notes and T-bills has not declined. It's actually risen. On a volume basis, I'm pretty sure it's at record levels. Investors are flocking to U.S. Treasuries. You're not in a bond market collapse. So that's the environment. Now, what do you do to prepare for the next recession? Before I jump into that, here's a chronology of CPM Group's concern, only starting in 2000. In November 2000, we issued our 2000 year gold yearbook. And when we issued it, we said we thought that gold prices, which were about $260 at the time, would rise past their previous peak of $850 and far beyond that, and that what we were seeing was a world that would have much greater economic and political risks, that would drive investors to buy more gold and silver, that would lead to what economists would call an upward shift in the investment demand curve, that investors would buy more gold and silver for a longer period of time in more parts of the world, more types of investors at higher prices than ever before. And that whereas we had seen these economic crises last 1 or 2 years between the 1960s and 2000, this one we thought would last decades. And that's exactly what's happened. Since 2000, it's been one major issue or a set of various issues after another that has caused investors to say, I should have more gold and silver in my portfolios. And governments around the world, for the most part, have acted to make that gold and silver more readily available, and in price, and the prices have been more competitive. In 2006, we started to talk to our clients about what to do to prepare your wealth portfolio. Your portfolio, and then there's your wealth, and your portfolio is really a subset of your wealth. What to do to prepare for a coming major economic storm. And I'll get to that in a second. 2008, the storm broke over all of us. It lasted through, while there was the recession from late 2007 through 2000 into 2009. And then we had sovereign debt problems in 2009 through 2011 in Europe, in other parts of the world, and in the United States. In August of 2011, the U.S. Treasury's creditworthiness was downgraded for the first time in history. Gold prices spiked up to a record peak at the time in September of 2011. We started telling our customers to sell their gold. We had started telling our customers to start selling their silver in April of 2011. On January, this is a typo. I knew I had a typo somewhere. January 9th, 2012, our Precious Metals Advisory was titled A Time to Sell. And we basically told our clients in published written form, formally, sell your gold and silver. 2011. 2013, we advised our long-term investor clients to go long silver, gold again. We thought that at $12.80, the price was close to its low. We were right, but it stayed at around that level for another 6 years. And in 2019, we advised our long-term clients to go long silver. Now, this year, we're saying it's time to winterize your wealth again before the storm arrives. These are our projections. You can see buying in November 2000, selling in January of 2012, buying again in 2013, a little prematurely. Silver, a little bit more cautious on that buy sign. Buy in November 2000, sell in April of 11, and then buy in 2019. So this is what you do. This is the meat of this presentation. What we told our clients in 2006 is the same thing that we're telling them today. In order to prepare yourself to weather any coming recession, preparing your wealth to not necessarily be completely protected, but as protected as we think you can be, first thing you should do is reduce or eliminate your debt. Second thing you should do is build your cash reserves. A, you might need them, and B, things will be very cheap once a recession comes and demand for financial assets as well as goods and services in the real economy falls off. So you want to have cash because there'll be investment opportunities. And then hold a significant part of your wealth, maybe 20 or 25%, in gold and or silver, or some mix thereof. Those were the three prescriptions that we had in 2006 in advance of the Great Recession and global financial crisis. Those are the preparations, the prescriptions that we have today in advance of what may be a recession in the next 24 months. Also, clean up your portfolio. Dump the weak stocks. Understand that while you might keep money in some stocks that really look recession-proof, when the tide goes out, all of the boats go down. I made that mistake in 2006, 2008. I thought that some of these stocks were recession-proof. They came back after 1 or 2 years, but they came out with the tide that took out a lot of those weaker companies. And remember that the tide will come back in. Now, if you look at past periods, and there is reason to think that maybe it's different this time. If you look at past economic recoveries following recessions, gold has tended to recover faster and sooner than equities. Just something to keep in mind, because we do like gold and silver. I mentioned this the last couple of videos. We issued a market alert on the 11th of October, just a week ago, although it seems like it's more like 9 days ago. A 9-page piece on our long-term economic outlook, including interest rate outlook, the dollar, and China's economy. We will issue probably next week another report, it's all but done, on deficit, debt, and gold, which is a companion piece. It was 7 pages long when I wrote this last Tuesday, but it's about 9 or 10 pages now. and I want to add some more to it, possibly yet later today or on the weekend. If you are a client, you'll get these free. If you're not a client, you can become one now. You can go to cpmgroup.com. You can send an email to info@cpmgroup.com. You can become a retail investment client, investor client. You can buy some of our yearbooks or other reports. You can retain us as advisors. If you are not a client now, but you become one, in order to get these reports and to have access to us, we'll also throw in a market alert that we did in September about the 1 billion barrel Indian rupee oil purchase that was paid for in rupees, and what it putting it into the context of the Indian oil market and global oil market, as well as the fact that it didn't really represent de-dollarization. That's all I have for now. Again, you can go to our website, get free reads, watch past videos, buy some of our research and consulting services. Reach out to us at info@cpmgroup.com. I'll be back next week. In the meantime, take care of yourself and those around you. And let's see what we can do to make the world a little bit better than it is right now. Take care.